I am very excited to announce that our first investment opportunity of 2020 is now available on our website, asimcapital.com. The deal is a diversified ATM fund, which is operated by an institutional quality operator who has invested more than $100 million in ATMs over the last 8 years. The ATM business is really unique because if you get 10 investors in the room and say, hey, everyone, I'm investing in ATMs, 4 of them will probably walk out of the room immediately without even hearing you out. And I have found that that's about the perfect ratio for creating very compelling investments and long-term asymmetric returns. I'll tell you why. This particular manager has a strategy in terms of the placement of the ATMs themselves, where they focus on locations where the demand for the product is inelastic, and perhaps more importantly, the consumers themselves have low credit scores, making them unbankable. So it creates an interesting dynamic where the worse the economy does, the more people have low credit scores, the more people are unbankable, and it creates a unique recession-resistant play. And that's just one of many very compelling things about this particular offering. So if you're an accredited investor, you can get instant access to the offering on our website, asimcapital.com. That's ASYM capital.com. Like I mentioned, it's the first deal that we've put out in 2020. So it's likely that the first tranche will be oversubscribed very quickly. Head over to asimcapital.com if you're interested, and you can learn more on our website. And of course, just a quick disclosure, investing in private placements, there's always a degree of risk, including illiquidity of the investment. You can't just sell it whenever you want. So make sure to read all the offering documents before investing, including the risk disclosure section. Now, this investment is offered to U.S. investors through Growth Capital Services, which is a member of FINRA and SIPC, located at 582 Market Street, Suite 300, San Francisco, California, 94104. What's the difference between return on investment and internal rate of return? This is a really important question. Both of these calculations are useful and used frequently in the industry, so it's really important to understand the differences and how to communicate and how to use them correctly. So, first of all, return on investment is a very straightforward, simplistic calculation that is used a lot because it's easy to explain. It's basically the average annual return on investment. So what this means is if you take a $100,000 investment and you then, when all said and done, you make a total of $100,000 of profits, the calculation for the return on investment is as follows. $100,000 of profits divided by the $100,000 investment divided by the number of years invested. So if it took place over 5 years, that return on investment would be 20% annualized. We would refer to this as a 20% ROI or annual ROI. Now, people use that a lot because it's as easy to explain as possible. And because of that, passive investors are familiar with it. They can do it on their own, etc. Now, the other calculation, though, is IRR, the internal rate of return. This is a calculation which is far more complicated. It has to be done in a financial calculator or in Excel. And the key difference is that it actually accounts for the time value of money. So in the previous example, I mentioned that you invest $100,000 over a 5-year period, you make $100,000. I didn't specify when that $100,000 is paid out, but that is extremely consequential to investors. 2 reasons. Number 1, the time value of money is very significant. Also, it's important from a risk assessment basis. How quickly am I getting my capital back during the hold period? We'll take that second part for maybe a different Monday Minutes, but let's focus on the time value of money. When you're calculating IRR, let's say you had that exact same result. You invested $100,000. You receive around $8,000 a year in cash flow, like a typical real estate deal, and then on the end of the 5th year, you've received $40,000 in cash flow, and then you receive another $60,000 in gains. So that circumstance, the total profits are exactly the same. You made $100,000, but the time through which you actually received that money is calculated based on IRR. That IRR would be 16%. That's what the IRR calculation would show. Now, the return on investment, the ROI, still would be that exact same 20%. So there's about a 4% difference in that circumstance between the ROI and the IRR. But again, that doesn't paint the whole picture. There's other deals that have more pronounced either upfront cash flow or back-ended cash flow. Let's say you invested in a development deal, for example. And I'll just make the point and extrapolate it out a little bit. So don't get mad at me if you invest in development and you know that this is not typical, but just to make the point. So let's say you invest $100,000 and then at the end of the 5th year, you get all the proceeds. So you get no cash flow leading up while the property is being developed, while it's being tenanted, any of that. You invest $100,000, 5 years goes by, you get nothing. And then at the end of the 5th year, you get a total of $200,000, representing $100,000 of profit, right? You invested $100,000, get $200,000 at the end. Now again, the ROI calculation, exactly the same. $100,000 of profit divided by the investment amount, divided by the number of years invested, you get 20%. Now, if you put that same cash flow stream into an IRR calculation, you get 14% because you're getting so much of the cash flow, all of it, at the back end. It really does make a difference because of the time value of money. So you can see in that circumstance, the cash on cash or the average annual ROI would be 20%, but the IRR would be 14%. So a 6% difference showing that the cash flow really does matter in terms of when you get that. Now let's take another example just to kind of close this loop. Let's say you invest in a note. So this is not a real estate deal. You're investing in an IOU. The paper just says, I owe you this predetermined outcome. And if you don't get it, you can foreclose on the collateral or something like that. So let's say you invest $100,000 and what you're going to get is $30,000 per year for 5 years. That's it. You don't get to sell the property at the end. You're not getting the benefits of appreciation or anything like that. You're just getting this IOU that says, I'm investing $100,000. I'm getting $30,000 per year for 5 years. Now, if you input that into a financial calculator, you're going to get about a 17% IRR. That's very, very favorable. And the reason it's favorable is that it's accounting for the fact that you're getting a lot of your money back every single year. You can reinvest that capital. You're getting paid very, very quickly. However, if you put that same cash flow streams into the simplistic ROI calculation, you're just taking 30,000 times 5 equals 150,000. Take away the investment amount, which is 100,000, you're left with $50,000 of profit. Now you've got $50,000 of profit over 5 years, over a $100,000 investment. You would be left with only a 10% ROI, annual return on investment. So in that circumstance, the IRR is much higher, but the ROI is lower because the total profits are lower. In the last example, the ROI calculation is actually much lower because it's not accounting for the time value of money, which is extremely favorable in the note example. So obviously it's a little bit technical, a little bit detailed. Both are really important. From my perspective and from my experience, I'd say that if you're investing in typical value-add focused real estate deals, where the deal is starting out cash flowing and you hold it somewhere in the range of 5 to 10 years, you're typically going to see about a 2 to 4% delta between the ROI and the IRR. Usually the ROI is higher. But things start to get a little bit crazy when you start doing things like investing in development, for example, investing in notes, which are amortizing, paying themselves down. It's just really important to know. Now, like always, it's really important to understand what the market dynamics is or are, because you want to be able to communicate effectively. So if you're the only one using IRR frequently, you're going to constantly have to explain what that means, and you're going to constantly have to explain the complications regarding how to calculate it. But if most of the market is using ROI, then that can obviously create some benefits as well. You just got to know what these terms mean. Some firms use both. Both are important. Just trying to give you all the tools possible. Thanks again. All right, listeners, you know the routine. This show is all about learning, making wise investments, and protecting and growing your capital. So if you're interested in these topics, make sure to hit the subscribe button. Of course, if you've already enjoyed a couple of great episodes, don't be shy, leave a review. It really helps the show's visibility. And lastly, if you're an accredited investor and you're interested in learning more about our investment opportunities, the types of deals that I personally invest in, go to asymcapital.com. That's ASYMcapital.com. Thanks a lot.